for those two things to be true, using it as a wealth builder and its ease of accessibility, we need to throw out some head trash. And we're going to do that by busting some myths. What's up, accumulators and decumulators? Welcome back to the Functional Retirement Podcast, where we get technical about your wealth, philosophical about your purpose, and inspirational on your fitness. I'm your host, Thatcher Taylor, and today I'm turning into a myth buster. You remember those old shows, the Myth Busters? That's what I'm going to be today. I'm going to go over 5 myths of the stock market and some examples of each, most of which are going to be provided by JP Morgan's research team. So you know what? It's got to be good. Well, sort of. I'm kind of kidding, but I'm kind of serious too. People think that the stock market is this mythical place that is reserved for stock pickers and the wealthy. I don't think that's true at all, and it couldn't be further from the truth. I'm more on the side of the stock market being the biggest single wealth creator tool in existence, and it couldn't be easier to access. But for those two things to be true, using it as a wealth builder and its ease of accessibility, we need to throw out some head trash, and we're going to do that by busting some myths. Each one of these myths have some truth to them, however, like everything does. Everything in life has a little bit of truth to the other side, which I'm going to discuss on each myth. But for the vast majority of traditional wealth builders, pre-retirees, and retirees, the truths on some of these are not going to apply. Before we continue, the majority of you are listening to this episode on your podcast platform of choice. So I'm going to link these documents that I'm going to go over in the show notes so you can review them and follow along. But this is also being recorded, and we're going to upload it to the Functional Retirement YouTube. So just click the link below to be rerouted to YouTube if you want to watch and follow along together. Or you can just search Thatcher Taylor or the Functional Retirement, and it's going to be right there at the top. So before we actually get to the meat of this, I need you to do one of 3 things, at least one of 3 things. I need you to leave a review, especially on iTunes or Spotify, so we can keep this thing growing. I appreciate high quality reviews. And to be honest with you, so do the platforms. The second thing I need you to do, or one of the other options, is ask a question for future Q&A episodes. I love questions, and it most likely will be developed into an episode. And number 3, subscribe to the channel or follow on the app that you are listening to. So as usual, we can grow together. Now, let's charge into these myths like William Wallace and Braveheart. You remember Braveheart? William Wallace, he's leading Scotland, tell them Scotland is free. That's what we're going to do here. So myth number one is you're going to lose everything in the stock market. The other way that people like to phrase this is stock market's gambling. It's like gambling. I think I'm going to show you enough data to prove that it's not like gambling, and you're most likely not going to lose everything unless you're doing something ridiculous like they used to do in the old days, where you're buying 1 or 2 really unusual stocks with all of your assets. So to illustrate this, we're going to go over some charts here that I think are really valuable. And the first thing that we need to look at, just to set the stage of the stock market, the stock market, the way that I'm going to refer to it, is holding hundreds, if not thousands, of different securities in some sort of diversified investment, like an exchange traded fund or a mutual fund or an index fund. That's how I'm going to refer to it today, because for the majority of people, and I literally mean the majority of people, regardless of wealth, just need this type of investment or group of investments for their wealth building journey. This first chart here first shows that the S&P 500, so the 500 largest companies, where the biggest ones, the S&P 500 holds a little bit more than the smallest ones, but still the 500th company in the S&P 500 is still a large capitalization company, which means it's very, very big. The annual returns of the S&P 500 over the past 43 years can range anywhere from being up 34% to its very worst year of being down 38%. And you know that was in the year 2008. But the majority of the years on this chart are up. And that's a historical commonality with the S&P 500 is that 4 out of 5 years it's going to be up. It's going to make money before it loses money. In fact, the annual returns were positive in 32 out of 43 years, the past 43 years, I should say. What's interesting about this chart we're looking at is the intra-year declines. So people are going to say, you're going to lose everything. You're going to lose everything. So myth number one, you're going to lose everything. Over the past 43 years, you have not lost everything. In fact, you have made substantially more in returns than you have in losses. The biggest intra-year loss, so an intra-year decline or loss, is from at some point in that year, the market dropped. It went its lowest of 49% in year 2008, but end of the year, negative 38%. In, let's say, 2021, for example, the market was up. It ended up on the year 27%, but throughout the year, it had an intra-year decline of negative 5%. This is showing us that it is not guaranteed on a day-to-day basis that the S&P 500 or investments like it are going to make money. But over long periods of time, historically, it's made money. Now, this isn't a recommendation to go by the S&P 500, but it's an understanding that to assume that you put your money in the S&P 500 and that you will lose everything is an absolute myth. Here's what would have to happen. If you go look right now, if you Googled the S&P 500 or the companies in the S&P 500, it's going to be Apple, Google, Microsoft, Amazon, Facebook or Meta, and then it's going to be NVIDIA, Procter & Gamble, Johnson & Johnson, all the biggest hospitals or pharmaceutical companies, tech companies, automotive makers, banks, cell phone companies, communication companies. Everything's going to be built in the S&P 500. You know what it would take for you to invest $1 million in the S&P 500 and your $1 million to go to zero? You know what that would take? It would take the first scenario, which is in your control, where the market dropped, you sold it off. You invested, the market dropped, you sold it off again, and you just kept selling it off at market drops until it went to zero, which I sure hope that wouldn't happen. The other way is all of those companies go to complete zero, because that's what the S&P 500 or a diversified portfolio within an ETF or mutual fund is the fund managers accumulate the underlying investments. The underlying investments are based on the performance of those companies. If those companies go under, then the investments go to zero. All of them would have to go to zero. That would be a complete calamity. So I don't think that's going to happen. I really don't. That doesn't mean there isn't volatility, but to say that your investment is going to go to zero in a diversified portfolio is highly unlikely. If we want to get deeper into the returns, just so you have expectations on what should happen, you can see here that in any given year, the S&P 500 is going to be up 47% or down 39%. We kind of talked about that. In a 5-year rolling period, so every single year starts a new 5-year rolling period, and every single year, a previous 5-year rolling period ends. The average 5-year rolling is 28% for the S&P 500 and negative 3%. So the majority of the time, you're going to make money over a 5-year period. That's the worst 5-year period. The worst 5-year rolling period since 1950 has been down 3%. The best 5-year period since 1950 has been up 28%. A 10-year rolling period is 19% was the high and down 1%. So since 1950, The worst that a period of 10 years had in performance with the S&P 500 was negative 1%. I'm willing to bet that that was 2000 to 2009, if I had to guess. And then this is where it gets to be the best. In a 20-year rolling period, so every year starts another 20-year rolling period. So when we're looking more long-term, the best that the market has done in a 20-year period is up 17%. The worst it is done in a 20-year period is up 6% on average. This is starting to understand that over periods of time, the market is going to do really, really well. In single windows of time, like a year or shorter periods of time, there's going to be more swings in price, but you're not going to lose everything. So I said I'd play devil's advocate. I'd tell you the other side of the spectrum. Where might you lose everything is what I kind of mentioned before, but also the stock market could be many different things, including buying individual companies, really buying small companies or mid-sized companies that go under. Those could be places where you could lose all of your money. Because remember, it's based off the performance of the company. But what we do in an ETF or a mutual fund is you have thousands of these companies to help boost up the negative performance of one or multiple. As we move on here, I really like to show this chart. It's called the S&P 500 Index and Inflection Points. Essentially what that means is it's just a chart showing the performance since 1996. You can see it goes up and down, but there are runs where from 2008 to essentially 2021, there was a substantial run in the marketplace where it was up a substantial amount. It's telling me here from 2008 to 2020, the market up from that period of time, that 12-year period, the market was up 400%. What are you telling me that you're going to lose everything when over that period of time? Yeah, there's some volatility where it's up and down and kind of flat throughout those years, but it makes far more than it loses historically. Okay, so myth number 2, active trading produces better results. Active trading produces better results. I really like to quote this one is they thought they had a crystal ball. It's common to hear advisors or professionals in the industry make predictions. They think they know what's going to happen next, where it is so unpredictable, it's not even funny. But to prove this, there's something called the SPIVA. The S&P really comes out with a really cool report called the SPIVA, S-P-I-V-A report. You can see it here if you're watching. This will also be linked below if you want to check it out. This equates the active management of funds versus just the standard marketplace or just buying the index. And here's what this tells us. Although active managers in a number of categories were able to outpace their benchmarks in the first 6 months of the year, in our largest and most closely watched comparison, 60% of all active large cap United States equity managers underperformed the S&P 500. If it was so easy to produce better results, it would be far more than only 40% of active managers beating the S&P 500 index that I was just discussing in myth 1. 60% of them underperformed because it is really difficult to produce better results than what the market is giving us. You cannot believe how many regular investors are out there buying and selling individual stocks using active management tactics to try to beat the S&P 500 when in actuality, the S&P 500 is all you need. That's your bread and butter. We can see here, this isn't just US large cap growth. If you read through this, this extends further into all different segments of the market. Growth, value, mid cap, small cap, REITs, international. Most active managers in all of these areas underperform their specific benchmark or their index that they're trying to beat. These are actively managed mutual funds. So they're bundles of underlying stocks that have a fund manager or a team of people buying and selling underlying securities on an active basis throughout the year at their discretion. And they're doing this to try to beat their index. It's really, really hard to do that. Now, I told you, I'm going to play devil's advocate. I'm going to be on the other side. There are individuals that do this. 40% of active managers are beating the index as of the past year, which is pretty good. But by how much, we don't know, maybe a little bit. But for us to believe that we could do it is a fallacy in a lot of cases. But some of us can do it. In most cases, they'll do it they will have made a purchase of, say, something like Apple or Microsoft or Google, and they will have overweighted into a company and they will have hung on for a long period of time because a lot of those returns don't manifest themselves until later. So it's possible for you to do it on your own, but in most cases, it's unlikely to succeed. And that's because of behavioral issues, because through that run to be able to outperform, you got to be able to weather unusual market scenarios, including things like COVID and unpredictability, and being able to stay in and hang on for dear life. Myth number 3. Myth number 3 is savings accounts are safer than investing. Myth number 3 is savings accounts are safer than investing. In the short term, yes. In the long term, no. Here's what I mean. A savings account is a place that we can store money that we need in the immediate future. And what happens when we store money in the bank or in a savings account is we are losing money to inflation. Cost of goods are increasing faster than the rate that we are receiving in the bank. So we're losing a pretty substantial amount over long periods of time of our purchasing power. The reason I have this as an investing myth is because people will say, I'm not losing any money in the bank, whereas the stock market, I'm losing all my money, which is a fallacy because every year that you keep your cash in the bank, you're losing money due to inflation. And the historical inflation is 4%. Is 4%. So it's really difficult to believe. In fact, let me pull this up right now. As you can see here, the CPI and the core CPI, the average consumer price index or inflation, the 50-year average is 4%. Right now, it's very high, or at least it's calmed down. I should say it's 2023 now, but historically, the past 2 years, it's been very high. You're losing money in the bank. It's becoming a guaranteed risk that you're losing your purchasing power. This is actually called purchasing power risk. So when we go to the myth that a savings account is safer, it is in the short term, because we talked about on myth number 1 that in any given year, the S&P 500 could be up 40% or it could be down about 38%. So there is volatility, but over long periods of time, you're going to make money in a long-term investment like the S&P 500. Whereas the bank, if you kept money in the bank over 20 years, it will be eroded to simply nothing because of purchasing power. You can put 100 grand in the bank now, and in 20 years, you'll have 100 grand in the bank again. But that 100 grand is going to buy substantially less. That's your purchasing power. This is something that we really need to be aware of when we're making the decision whether or not to put money in the bank or to invest it. And most people will avoid investing because they're scared of the price fluctuations. The price is going to go up, price is going to go down, but that's going to make you very concerned. That's something that we need to potentially avoid if you're going to really accumulate wealth. And what you can do is you can go back to the previous podcast where I talk about the specific methodologies and how you should approach your cash management structure. In a nutshell, you only want enough cash to protect you, and that cost of inflation is just the cost of protection. And then the rest of your assets need to be invested in a way that meets your goals. Moving along smoothly, we're moving on to myth number 4. Investing in stocks is too complicated. This is a very interesting idea that investing in stocks is too complicated because of the advancements of technology. Before, let's say 30 years ago, you want to invest in a stock, you would need a broker of some sort. You'd need a person that you'd have to call to create a trade for you to buy the specific security. That's unrealistic. Now we have the ability to invest very easily. You could go open an account at Vanguard, Fidelity, Charles Schwab, and go buy one of their index funds that encompasses the entire stock market, 3,000 securities, and you could do it in a matter of minutes. You could link your bank account and do it in a matter of minutes. So being able to invest is too complicated, but this is just a burden that avoids the power of compounding and the length of time that it takes to really accumulate wealth. The simplicity allows us to be able to automate our investments, continue to buy in on a very simple and easy basis on a regular basis to continue to accumulate the foundation that's going to be for future compounding. Now, here's an example. Let's say you wanted to go buy a stock with $10,000. We don't really know what that stock's going to do. We don't have a ton of historical return on a lot of these stocks. Some we do, some we don't, but there's so much volatility with an individual stock. But you can see here in this chart in 1993, if you invested $10,000 and you reinvested the dividends in the S&P 500, it would now be worth $166,000. $10,000 to $166,000 over the past 30 years by just investing in the S&P 500. Now, if you would have done that subsequently, $10,000 every single year for 30 years, it would have made a substantial difference in your retirement vision and your goals being achieved later in life. It's important to avoid the complexity as an excuse with how simple it really is to get money working. You can even see here, you can invest in different asset classes and their potential growth over long periods of time. The reason why these different asset classes are important is because you don't have to try to research and develop a strategy on one or single security or maybe two single securities. You can have a diversified portfolio of large cap, mid cap, small cap, domestic, international, and everything in between. Growth, value. There is a way to easily purchase high quality investments that grow over long periods of time that achieve your goals. So now that we've debunked that myth about how complicated it is, the other side of the coin about its complexity is it is sometimes hard to choose. It is sometimes hard to really decide what you should invest in. If you're not willing to do the due diligence and the research, that's when an advisor or someone along the way would be most valuable in your case, so you can get money working and avoid a lot of these mental roadblocks from doing what's important to achieving your goals. So we're going to move into our last myth, but before we do that, I want to say thank you for everyone for listening. I appreciate it. Please make sure to like and subscribe, submit a question, or leave a review. If you want to work with me in my business on your retirement planning and accumulate wealth, down below there's a link where you can get started. It'll contact me directly and I'll reach out and we'll schedule a time to chat together. So myth number 5 is my favorite myth. Timing the market is going to make more money. I think the first place to start with timing the market is to talk about how impossible it is to time the market. Right here, we can look at the most recent geopolitical events, none of which were predicted by any of us. Russia-Ukraine war. Now this is recording and this document was created. There's the Israeli-Palestinian war. But before that, there's the intervention in Syria. There's a different Ukraine conflict in 2014. Arab Spring, the Iraq war, the 9/11 attacks, the entire war in Iraq, the Kosovo bombing, the first Gulf War, the Libya bombing, the Soviet invasion of Afghanistan, Iranian hostage crisis. There are so many things that happen along the way. Inflation changes, rate changes, Black Monday, tech burst, housing burst. Very few people were able to predict these along the way, and the market specifically wasn't either. So these geopolitical events and all the other things that happen in our world make it very difficult to time the market, buy the highs or buy the lows and sell the highs. It is so difficult to do that in actual practice, where it's maybe more valuable just to buy in consistently. Another chart here shows a variety of other things that have happened since 1900 and how the market actually performed in chart form. You can see through some of these segments, nothing happened. Through some of these segments, a lot happened. But you can see through scale here that even when there was volatility, the market was still either flat or moving up over extended periods of time. This chart's a really cool one where we can see the actual movement of the portfolios as they move vertically or even through stagnant periods of time. One stagnant period that I like to talk about the most is 2000 to say 2012. You can see there was an up period in 2000 or 99, I should say. It dropped, came back up, dropped again in 2008, and then worked its way back up. You can see giant zigzags in price fluctuations, but it's flat through that period of time. So if you were just able to hang on and buy yourself some time, you actually didn't lose any money, and then you're a part of a run for about 8 or 9 years. It's impossible to time the market. But what happens with timing the market is we miss the best days. So another statistic that I want to explain is usually when people are trying to time the market, they spend periods of time out of the market where money is sitting in cash, getting burned by inflation. But a $10,000 investment between January 1st, 2003, which was the bottom of the market after the dot-com bubble, and December 30th, 2022, so a pretty legitimate 20-year period or the most recent 20-year period. If you stayed fully invested through that period of time, all through the nonsense, a flat decade, the housing crisis, and then the 2010s, your investment in the S&P 500 averaged 9.8%. That's pretty dang good. But if you missed the 10 best days, and there's a trick about the 10 best days that I'm going to share with you here in a second. If you missed the 10 best days through that same period of time, you only averaged 5.6%. But here's the kicker. 7 of the 10 best days occurred within 2 weeks of the 10 worst days. Most people behaviorally in the worst days or the worst periods of time are going to sell out and move to the sidelines. In doing that, you sit on the sidelines for so long, you actually miss the best days that when you get back in, those best days were the most valuable days. If you miss 20 of the best days through that same period of time, you average 2.9%. You need to just stay invested for long-term goals and weather the storm with money that you do not need in the short term. So only money that you need in the short term needs to be put in the bank, but the remainder of the assets you need to put in assets that grow for long-term goals. I hope you enjoyed debunking these 5 myths with me. Myth 1, you'll lose everything. Myth 2, active trading produces better results. Not true. Savings accounts are safer. Not always true. You're actually losing money. Investing in stocks is too complicated. Investing in stocks couldn't be easier. And timing the market is going to make more. Not necessarily. In fact, you could potentially lose more by trying to time the market. I think these 5 myths are things that you can take with you as a behavioral and strategic change in your growth, in your portfolios, and how to develop your portfolios to achieve your retirement goals, because that's all it is. Building assets to support your plan that achieves your goals and the vision. I hope you enjoyed this. I can't wait to see you next time. Please make sure to hit me with any comments, questions, or concerns, and like and subscribe. Thanks for watching. Thanks for listening.